Here we are. We made it to the last chapter in the book. Congratulations. Glad you've hung in here so far. Now in chapter 10 we aren't going to do transfer pricing at all. So really we're just concerned with the performance measures and I guess you understanding the difference of different responsibility centers. So chapter 10, let's do it. Let's finish up this thing. Alright, so we're going to define RCs, why you decentralize, what are the most important measures that we use to evaluate performance, and let's do it. So responsibility accounting is a system that measures the results of each responsibility center and compares them with some measure of expected or budgeted outcome. So a responsibility center is a part of the business whose manager is accountable for specific activities. So like when I worked at banks, each branch was a responsibility center or an RC. We called it RCs. And so each branch was its own RC and it had an account number, RC50, let's say. Branch number 50 was RC50 and all the general ledger accounts had a separate RC that you put in. So when you recorded a transaction, you not only recorded that transaction, that debit or credit to that asset, that liability, that revenue, that expense, you also recorded it by the RC number. So each RC had its own ledger. Basically, there was a ledger for every responsibility center. So you had to plug in a RC number plus the account number for whatever kind of revenue you were doing the transaction for. So that way you could track things by branch. I could pull up, well, how much revenue did branch 50 have, and I could just pull that up. Or if you want to do all of them, you'd pull up all the branches, but you track things by responsibility center. Organizations who do this kind of accounting tend to separate their centers, right, their responsibility center into cost, revenue, profit, and investment. So a cost center would only have costs, right? So something like your accounting department, your human resources department, those are cost centers. They do not make any money for you. A revenue center is responsible only for revenues. This would be a place where they don't have any ability to determine how much they pay for their expenses. So out at our branch offices, our managers did not get to choose things like how much they paid people. They really didn't have a lot of choices. So they were a revenue center. But if they had choices, if they were the kind of place that had choices and they're responsible for both revenues and costs, they'd be called a profit center. And an investment center would be responsible for revenues, costs, and investments. So you might hear these terms used out there when you get out in the world. Well, we're a cost center, we're a profit center. So, that helps. What they do is they track everything separately so they can decide who's doing well, who's not doing well. Compare this branch office, this responsibility center, this RC made a better profit than this other branch office, this other RC. Okay, so decentralization is this concept where folks out there at lower levels are making important decisions. So you can imagine if you are Walmart and you let the store managers decide what to order for the store and how much to order for the store versus that's decentralized. Centralized would be the headquarters at Walmart just decides how much every store gets and they ship it to them, right? So centralized, the central location, the boss at the headquarters makes all the decisions. Decentralized, there's folks out there, out in the stores, out in the branches, the salespeople out doing stuff, making decisions. So centralized versus decentralized. Decentralization means we're delegating decision-making authority to the lower levels, right? So when we do that, we've got better access to local information. So think about our H-E-B in Kingsville. Probably doesn't need to have the same kind of groceries that the H-E-B in downtown Austin wants to have, right? So there's going to be different things. So you have better access to local information. Certainly there's limitations that one person at a central office can do, more timely response to things going on. focuses central management on the things that are important to the overall for the company, instead of just trying to think about, oh, what's going on out in Kingsville, right? The HEB headquarters in San Antonio can think about, where do we want to expand, what do we want to do, instead of what do we need to order for Kingsville. Training, it's typically seen as a pretty good idea. Decentralization, enhanced competition, so the branch managers will work hard to get promoted because they're kind of competing against one another. So I want to do my best job. I want to make my branch look the best. I want to make my store look the best. I want to make my department look the best, because that will get good attention for me. Usually achieved by segmenting into decisions. Some of these it's pretty easy. So you're a manufacturing firm and you make pencils and you make pens. You could just separate it into the pencil and pen division. Let them, see how they do. Where I worked in banks, we pretty much were decentralized through our branches. So every branch did its own separate thing. Although we did also have divisions: mortgage loan, credit card, things like that. So decentralization, you kind of divide things into divisions, in ways that make sense, right? So cost center, generally you just see how efficient they are. So if something like a cost center, you might have the human resources division, the accounting division, the audit division. So you have to look at those centers in a way, if you're going to try to see, okay, they're doing a good job. Well, they're not really in competition with each other. You can't compare. You can compare branch 1 with branch 2. You can compare the Kingsville store to the Corpus store. But you can't really compare accounting to human resources very legitimately anyway. So you try to see how well they're doing their activities, and if they improve at doing their activities that they're supposed to be doing. So you've got these different units, right? Not cost objects, but different units within your organization. So how do you compare them? If you're going to compare Kingsville store to Corpus Christi store to Austin store to San Antonio store, how do you compare them? Or you're going to compare the pencil division to the pen division to the highlighter division, all right? How do you compare them, see how they're doing? Well, there are some typical ratios that we use, some typical, I guess they'll call them performance measures, right? So the performance measures that we use to compare typically tend to be things you've probably heard of before. So return on investment is one. So let's talk about return on investment. Return on investment, operating income divided by average operating assets, right? So pretty simple. You can do it by margin. But it's, typically it's going to be your return on investment is the most common measure. Operating income refers to earnings before interest and taxes. So basically, think about, if you think about an income statement, you start with the top at sales, minus your cost of goods sold, then minus selling and admin expenses. That's what we call operating income. And so you can figure out that stuff for different divisions within one company, right? And average operating assets are just the beginning plus the ending divided by 2, right? So you say, okay, on January 1st, what were our operating assets? And on December 31st, what were our operating assets divided by 2? Is that exactly perfect? No, because you acquire and discard assets differently over the course of the year, and they're worth different values. But that's a good way to do it. And operating assets tend to be your property, plant, and equipment, right? Your long term. So they don't change that much. All right. So ROI is nothing more than operating income divided by average operating assets. Pretty simple. You can break it down into the ratio of operating income assets to sale, that's margin, and turnover, dividing sales by average operating assets. So we can have margin and turnover. All right. The advantages of return on investment: encourages investment center managers to focus, encourages cost efficiency, discourages excessive investment in operating assets. So it helps us just keep track of what we're doing, and it allows us to compare. The disadvantages is discourages managers from investing in projects that would decrease ROI but increase profitability overall. It tends to focus on short run at the expense of the long run, right? Because if you're going to invest in some assets, that costs a lot. If your sales aren't growing as much as your assets right now, then your asset turnover, your margin, your ROI are all going to look bad for a little while till you catch up with those new assets you bought. All right. So performance measures lets you compare one division, one office, one branch to another one. And one measurement we use is ROI. So if you go out to problem 10.7, exercise 10.7, I work some of these for you out there in exercise 10.7. But like I said, you should be pretty good at these little ratios. All right, so I'm going to stop here, come back for the last video, talk about a few more performance measures, but not transfer pricing because we're not doing transfer pricing.